Hello everyone and welcome back. In today's video, I'm going to be going over the best ETF investment combo for a very simple dividend portfolio. And this is actually a ETF combination that I use, so I am putting my money where my mouth is. So I'm going to be going over why SCHD and JEPI are the best combination of dividend ETFs for a dividend portfolio. And if you do find this information helpful, please subscribe for future content. So reason number one why this ETF combination is so powerful is the dividend yield that it offers. So SCHD is a pretty high dividend ETF on its own at 3.84%. And it does pay quarterly, and this is very consistent. And the great thing about this ETF is that it grows its dividends over time typically. SCHD on its own has a 5-year average dividend growth rate of 13% about, and it's been growing its dividend for 12 years. So you get the benefit of a pretty high yield dividend ETF and also a dividend ETF that grows its dividend pretty substantially over time. So going more into the dividend, I feel that most income investors want a ETF or dividends that are consistent and pay pretty frequently as it supplements their income. And with JEPI, it offers a high dividend yield, but it also gives the benefit of consistent monthly payments. So if you look at these payment dates, you see that JEPI pays around the first week of every single month consistently. And again, this is a high yield dividend ETF that offers a monthly payment. So if you're looking for that consistent income, JEPI is going to provide that, while SCHD is going to provide that dividend growth. JEPI is going to provide consistent monthly income, and it's also going to provide it pretty substantially as well. Now, SCHD, the Schwab U.S. Dividend Equity ETF, is a very popular ETF among investors, and this basically invests in a conventional way. It selects a number of dividend stocks that have a history of growing their dividends, and it invests in stocks then further for their fundamental strength relative to their peers. So it picks a group of stocks that grow their dividend and consistently do that, and then further filters them based on financial ratios. Now, JEPI, the JPMorgan Equity Premium Income ETF, does a different investment methodology. It basically invests in a defensive equity portfolio that is based on a low volatility, and then it uses basically exchange-linked notes that operate as an option premium to generate a lot of that income. So you see that JEPI gets approximately 1 to 2% of its income from dividends, and then the other 5 to 8% from options premium. So it definitely is a options premium portfolio more so than it is a dividend premium portfolio. And this is great because it combines that SCHD conventional methodology, and then it also combines a different methodology with options premium. Now, what JEPI's option premium gives you is basically income relative to volatility. So in times of high volatility, your options income will increase substantially because premium expands with options. So in times when the market is very uncertain, you will increase your income. So as you could see, the payment kind of varies month to month, and that is because the options premium expanded and there is volatility in the market. So when the market is volatile, people don't really know which way it's going to be going. You're going to be getting more income, which is really good if you are the type of investor that is adverse to risk, because you can kind of sit back and relax in a way that volatility doesn't really scare you as much, because you're going to be getting paid more in times of high volatility. Now, this difference in investment methodology brings about another thing, and that is great diversification. So SCHD has a total number of holdings of 104 on its own. JEPI, on the other hand, has a number of holdings of 130. So each of these ETFs have a good number of holdings, and each of these ETFs have very little overlap. And to show you how little overlap each of these ETFs have, I took these ETFs, or at least the top 20 of their holdings, and I put them side by side. So to the left you have SCHD and to the right you have JEPI. And there are only 2 holdings in each of the top 20 that overlap, which is a relatively small portion. And if you notice SCHD's holding, it is very weighted to dividend stocks, of course, because that is its selection methodology. Whereas with JEPI, you're going to see a lot of various diversification. So you're going to see Amazon, Microsoft, Visa, MasterCard, Meta, Adobe, and you just don't get that with SCHD because it is very focused on its dividend selection method. On top of that, SCHD is very top heavy, which is good, but at the same time, it kind of lacks extreme diversification. So you're going to see that the portfolio, the ETF, has 70% of its total holdings in the top 20. So the top 20 holdings account for 70% of the ETF. Whereas JEPI, it's quite a bit different, and the top 20 holdings only account for about 30% of the ETF. And again, there is very little overlap between the two. So when you combine these two together, you're getting the benefits of the dividend stocks and the dividend growth that SCHD provides, while also getting the added diversification of JEPI and the high income it provides. So now we go on to performance. So what I did is I used the mutual fund version of JEPI to basically do a back test because it was around longer for the ETF version. So this back test isn't going to go back extremely far because the mutual fund or the ETF haven't been around that long. But what I did is I put $10,000 into it and I reinvested the dividends, of course, and I am stacking that against VYM, which is the Vanguard High Dividend ETF, because if you're a dividend investor, you're going to be comparing your performance to other dividend investments. So I did a 50-50 split of each, and we are going to see how that performed against it. This back test is going to go from January 2019 to December of 2023. So when we scroll down, we see that this combination outperformed the Vanguard High Dividend Yield ETF by about $1,000, and it offered a better yearly return, a lower standard deviation than Vanguard High Dividend Yield ETF did as well. So this ETF performed better. It's going to provide a higher income, and it's going to provide less standard deviation or less volatility. So when it comes to combining these ETFs, it does offer a good amount of benefits. It offers great dividends, it offers great diversity, and it offers a great return on your money relative to other ETFs that invest in the same field related to capital gains. So you're going to increase your capital probably a bit more than other investment ETFs that focus on dividends. And like I said, I do believe this combination is great, and I am the type of person that puts their money where their mouth is. I currently have about $28,000 invested into this ETF combination, and I do a split of 60% SCHD and 40% JEPI because I do want that dividend growth and higher capital appreciation. I am a bit younger, but maybe if you're looking for higher income, you can do a flip of 60% JEPI, 40% SCHD, or just balance it if you want 50-50 split on each. And so far, these are some of the dividends each of these ETFs have paid me over the past few months. So if we look all the way down at the bottom, you see SCHD, and if you go up, you see the consistent payments that JEPI provides. And I do put in more money every single week or every bi-weekly when I get paid. So those dividends are going to increase, and also the dividends are going to increase based on volatility for JEPI. So I am expected to continue to get paid more and more from these two ETFs due to volatility, the amount of money I put in, and because of dividend growth from SCHD. So this combination, of course, is very powerful, and I believe in it. And that is going to be it for today's video. Again, if you did appreciate this content, definitely subscribe for future content. I did hope you got some information from this video. Maybe you can employ this investment style going forward. So I'll catch you all in the next video.